Hey guys, it is Patrick, and before you dive into this lesson, I wanted you to know that you're about to start a new section of Principles of Accounting, and you can actually head to my website at www.patrickleemsa.com, where you can actually purchase and then download and then print the worksheets that go along with this lesson and all of the lessons that are connected to this section of Principles of Accounting. It's a great way to take notes so that you can actually concentrate on what I'm teaching you in our lessons, and then you can able to write notes along with the notes that I am showing on your screen. So all you have to do is head to my website at www.patrickleemsa.com. There you can purchase them and then download them, and then you can use them on this and all of the lessons that are connected to this section. So go ahead and do that. And if you are ready, let's head into our first lesson in this section right now. All right, in this lesson, we're going to be talking about payroll, and specifically, we're going to be talking about payroll from the employer standpoint in which you get a paid check. So we're typically the ones that will get a paid check, but how does the employer book that in their books? And that's what we're going to be looking at. So they're issuing you a paid check. The question is then how do they book it on their books? So we're looking at the employee deductions for a payroll check or payroll processing period. So it is kind of long here in this section, but there is a lot to it. And we're going to walk you step by step so that you understand how we can book an employee's paycheck. So let's get started here with understanding payroll. So when a company issues a paycheck to an employee, they aren't just paying the gross amount earned by the employee. So if you've earned $200, they're not paying you $200. They have to make some deductions because of federal or state laws. So companies must calculate and withhold payroll deductions from an employee's paycheck and remit those payments to other companies or government agencies. So they're kind of the third party in this transaction when it comes to actually taking money out of your paycheck and then paying someone else. So let's take a look at kind of some of the key terms here. So the first key term that you might hear or understand is gross earnings or pay. This represents the total amount earned by the employee. So for hourly, we might have hourly employees and salary employees. And for hourly employees, this is just simply taking the number of hours and times and multiplying it by their rate per hour. So if they work 10 hours and they get paid $15 an hour, that would be $150. For salary employees, typically the way that we calculate the gross pay is we take their annual salary and divide it by the number of periods in which they get a pay check. So for instance, if they got paid $120,000 a year and they get paid once a month, we would take $120,000 divided by 12 and we would get $10,000 a month. So that's kind of how we would calculate there. So that would be our gross earnings. From there, we have to think about payroll deduction. So these represent all the withholdings made to an employee's paycheck, which reduces the gross pay amount to the amount that is actually paid to the employee. So the payroll deduction amount is the difference between what the employee's gross pay is subtracting how much they actually get paid. So if they earned $200, but they only get paid $150, then the payroll deductions would be $50. So the payroll deduction is the difference between their gross pay and what they will receive from their employer, which we would get to net pay. So net pay represents the amount actually paid to the employees, to the employee after withholdings are made to the employee's gross pay. So we've got gross pay, subtracting our withholdings or payroll deductions gets us our employee's net pay. So those are three key aspects of payroll. Now let's take a look at the payroll earnings sheet that an employee would receive. So it looks something like this, and I know it might be a little bit small, but kind of just walking you through here, it looks like that this employee is an hourly employee. How do I know it's hourly? Well, if I look here, their rate is given as $37, and then we've got hours here, 40 hours, And then current, which is how much they're making in this period, is $1,480. Now, I don't have a calculator in front of me, but if I took $37 times 40, I could bet you that it would come out to $1,480. So that's kind of the top level of how do we calculate gross pay. Now, from there, this employee may have deductions required by law, or the employee has said to the employer, make these deductions on my behalf. So if we look here, just on the left-hand side where it says employee taxes withheld, we've got withholdings for income tax, federal income tax of $120.78, Social Security of $91.76, Medicare of $21.46, California state income tax of $27.37, and California state disability insurance of $14.80. So obviously we're breaking down what we're going to take out of this employee's paycheck. Now, in addition, there are some other employee deductions. Those deductions include a 401k deduction of $103.60. So we're going to also take away $103.60, and we're going to remit that to the employee's 401k account, wherever that might be, and that's usually based on the employer and the relationship they have with an investment firm or a 401k plan administrator. So 103 is also going to be taken out. So we're not going to worry about the employer's deductions right now. But notice we've got all of those deductions here, and then at the very bottom we get the summary. So our gross earnings is $14.80. Our pre-tax deduction and contribution was $103.60, and that $103.60 is based on this employee's deduction right here. That gives us, and then we've got our taxes of $276.17. So that's basically all of these taxes right here. And that gives us our net pay of $1,123. So it looks like that we withheld from our employees' paycheck about $380. So rounding off a little bit here, but about $380 is what we withheld. So that's with a payroll deduction. And so the net pay, which is what we're going to pay to our employees, what is $1,123. So that's kind of how you can read a paycheck at the end of the day, or the paycheck stub. Now let's work through some of these deductions here so that you have a better understanding of what these deductions are. So the first one here is income tax withholdings. Typically, this is one of the largest deductions out of an employee's paycheck. And that is their income tax obligations. Now, the income tax withholding is the estimated amount of income taxes that the employee will owe at the end of the year. So a misnomer is that the $103 that we took out, or the whatever it was, 100 and something bucks that we took out from the employee's paycheck to pay for income tax, is the actual income tax owed. And that is not true. That is an estimate of what we expect that employee to owe at the end of the year. At the end of the year, the employee is going to do their tax return and is going to get a credit for the amount that has already been paid. The difference between what they've already been paid versus how much they owe is the actual amount that they're going to have to either owe or get refunded on the tax return. So it's a misnomer that the income tax that comes out of your paycheck is the actual taxes that you're going to owe. That's just kind of a deposit. And then we're going to reconcile the deposit with how much you actually owe to either get a number that you owe even more, or a refund of overpayment that you made. So that's the income tax, one of the biggest parts of the tax, of the payroll deductions. Then you saw FICA. Now, FICA is in two parts, and you saw it split up on the paycheck. The first part is Social Security. The second part is Medicare. Now, with Social Security, these are deductions made for the purposes of providing retirement benefit during a person's retirement years. So if you heard of Social Security and the retirement that you would get from the government after you hit age 67 or 69 or 62 or whatever it ages, it's paid through this. So if you make contributions here, you're going to get that Social Security. Now, that is 6.2% of your paycheck. And there is a maximum that changes every single year based on inflation and what Congress says. So, but generally speaking, for most people, it's 6.2% of your gross pay. Now, Medicare, on the other hand, is a little bit different. So Medicare are deductions made for the purposes of providing a national health insurance. This is typically for old age, but also could be for disabilities in young individuals. Now, the way that this tax works, or this deduction works, is that it's 1.45% of your gross pay, and there is no limit. So you continue paying 1.45% on all of your income, regardless of how high your income is. That's different than Social Security, because Social Security stops when you've hit an income limit. So you keep paying, and then once you get that income limit, it goes to 0%. So that's kind of the difference between those two. So Social Security, Medicare, again, kind of the second biggest one combined that is deducted from your payroll or your paycheck. All right, state deductions. So state deductions are also a part of an employee's withholdings, depending on the state. Some may have income tax or disability income or insurance. So we're not going to cover that. We're only going to cover, the federal stuff, but there may be some state deductions that you're going to have to account for as well. So other deductions that could be made from a person's paycheck include retirement deduction. So you saw that with $103. So you can ask your employer to deduct some of your pay for retirement purposes. Medical, so health, dental, and vision also comes out of there. So you might have a premium that you need to pay in order to have health insurance, or have dental insurance, or have vision. That is usually deducted from your paycheck rather than you having to write a check to the insurance company. Other insurance deductions, so there may be life insurance, there may be cancer care insurance, there might be short-term disability. So there's a whole slew of different insurances that you can buy. And again, these types of insurances often are not paid by your employer, but instead paid by you, the employee. So those are other deductions that need to be made from the gross pay. We also have charitable deductions. So a lot of organizations will make it easy for their employers to donate to a charitable organization that either the company is supporting as a whole, or that you get to choose, and then that check gets sent there. So what companies try to do is they try to aggregate all the donations so that they can make one check to a charitable organization that maybe the company has, or maybe from a list of charitable organizations. So that's one way that we can get employees involved very quickly to donate money to different charitable organizations. The last one here is advanced paycheck. This doesn't happen a lot, but you might be in an instance where you're going to ask for maybe your pay up front, or maybe you need a little bit of an advance. So that might be deducted to pay back the company for the advance that they gave you previously. So those are other types of deductions. There are significantly other ones as well, but those are the main ones that you might incur on your own paycheck if you're reading your paycheck. All right. So these deductions are simply liabilities to the company in which they must remit on your behalf to another agency. So when we look at this, the company is going to withhold all of this and all of this. So they're going to withhold that. I think we said $380. If we total it 308, they're going to withhold it, but that's not theirs. They're going to need to take that $380 and distribute it to all the organizations that should be getting that. So for instance, the 401k plan is going to need $103.60. So that of the $380, $103 is going to go to your 401k. And then looks like this right here, that's 1, 2, 10, 230, like 230 of that will go to the federal government. And then you've got, $40 here for the state. So again, we're going to make sure that we remit those to the agencies that we are withholding them on your behalf as an employee. So what does this look like from a journalization standpoint? Let's go ahead and look at the journal entry for just this one check. Now, obviously, a company aggregates all the checks that they've cut and makes one journal entry. We're going to make one journal entry for one paycheck, which is not the case at the end of the day. But this is kind of how it goes. So how do we journalize this paycheck if this was our only paycheck that we're going to need to journalize? Well, first of all, we are going to have to pay this to our employees, and by us paying this to our employees, that would be an expense to us. So we will debit salaries and wages expense. And when we debit salaries and wages expense, we're going to debit it for the full amount that the employee has earned. So that gross earning. So that gross earning was $1,480. So we're going to debit salaries and wages expense of $1,480. And then the rest becomes payables, right? We're going to owe it to the federal government. We're going to owe it to the state government. We're going to owe it to the 401k administrator. So we need to book the payables for the amounts that we withheld from our employees' paycheck. So the first one here is going to be income tax. So we withheld $120.78 for income tax for that employee. So I'm going to credit a liability called withheld income taxes payable. And that's going to be in the amount of $120.78. All right, so that takes care of the federal income tax. Now we've got FICA. So FICA is Social Security and Medicare. So we're going to add up the 9176 with a 2146, and we're going to credit FICA payable in the amount of $113.22. All right, moving on to the next one here. It looks like we have California withholding, so I'm going to combine those there. So credit California withholdings payable in the amount of, looks like $42.17. And then we're going to credit one more thing, which is the retirement. So retirement payable. So credit retirement payable of $103.68. And then what's left? Well, what's left is our net paid to our employee. Our net paid to our employee was $1,123. So $1,123. And that could either be cash, if that's what we paid right now, or maybe we do this calculation on a Thursday, but we really pay them on Friday. It might be an wages payable. Okay, so again, understanding what we're doing here. In this case, it's going to be wages payable, or it could be cash, depending on if we're owing it now, which we're going to pay in cash, or if we are going to pay them at a later date. And oftentimes payroll is ran sometimes a couple days before it's paid, and so wages payable. And then when we actually cut the check and give it to them, then we turn that from a wages payable to cash. So either one is okay depending on what the circumstances are in the problem. So that is a look at accrued payroll. I know that there was a lot, but basically what we're trying to do is help you understand what deductions are, and then what the different types of deductions are, and kind of help you understand what's coming out of your payroll and your paycheck. And then finally, at the end of the day, what that journal entry looks like. So hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com, or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.